Switzerland manages $400,000 in assets for every single person in the country. Every man, woman, and child. $400,000 per capita in managed financial assets. A country with the population of New York City controls more financial assets than the entire economy of France. A landlocked nation smaller than West Virginia manages more cross-border wealth than London, Singapore, and Dubai combined. $3.45 trillion in assets under management. A banking sector with $3.4 trillion in total balance sheets. Private banking revenues of $21.4 billion annually from a population of 8.6 million people. These aren't abstract numbers. This is a functioning economic model that has worked consistently for over 2 centuries. Through 2 world wars, through the Cold War, through the 2008 financial crisis, through COVID, through every major economic disruption that broke other systems, Switzerland's model kept working. There are 4 core mechanisms that make this possible, 4 economic principles that Switzerland has mastered simultaneously while most countries struggle to get even one right. Understanding these mechanisms explains why Switzerland's economy functions the way it does and why the model has proven so durable. This is the money timeline. Today, we're going to examine Switzerland's economic model. We'll break down the 4 mechanisms that drive the system, analyze how each one works in practice, look at what happens when countries get some mechanisms right, but not all of them, and understand why this particular combination creates such economic resilience. This is about economic structure, not speculation. This is about how Switzerland actually works. Switzerland's economy operates on 4 core mechanisms that work together to create stability and attract capital. Most successful economies in history have managed to optimize 1 or maybe 2 of these mechanisms. Switzerland is one of the few modern nations that has all 4 functioning simultaneously. The first mechanism is trust monetization. This is the ability to convert institutional stability and reliability into recurring revenue streams, not one-time transactions or speculative gains, but predictable income from being trusted to hold and manage capital. The second mechanism is capital magnetism. This means creating policy environments that make capital want to flow in and stay, not through force or capital controls, but through making it economically rational to keep wealth there. The third mechanism is service capture. This is earning money by controlling, intermediating, and servicing economic activity, even when the actual production happens somewhere else. It's about owning the platform, not necessarily making the product. The fourth mechanism is adaptive resilience. This is the ability to change business models and policies when external pressures threaten the existing system without causing collapse or destroying the underlying economic structure. Each mechanism reinforces the others. Together, they create an economic model that's proven remarkably stable. Let's examine each one. Trust monetization is Switzerland's foundational mechanism. The country has built an entire industry on being trusted to hold other people's money safely and manage it competently. This model was codified in 1934 when Switzerland passed banking secrecy laws that protected client confidentiality. This created a legal framework that made Switzerland attractive to anyone seeking financial privacy and asset protection. Whether those motivations were legitimate tax planning, protection from unstable governments, or estate planning, Switzerland offered a stable jurisdiction with strong property rights. The business model is straightforward. Swiss banks charge custody fees for holding assets, management fees for administering them, and advisory fees for providing financial services. On $3.45 trillion in assets under management, even modest fees generate enormous revenue. A 0.5% annual fee on that base produces over $17 billion in recurring income. This is not speculative trading revenue. This is not dependent on market performance. These are fees for service, paid regardless of whether markets go up or down. Swiss private banks earned 21.4 billion Swiss francs in revenues in 2024, up from 18 billion francs in 2020. During a period of global financial stress, revenue increased because the service being sold is stability and trust, not returns. The key insight is that Switzerland monetizes reputation. Clients pay for institutional continuity, regulatory predictability, and the confidence that their assets will be there in 10 or 20 years, regardless of what happens politically or economically elsewhere. To understand why this matters, consider the counterexample of Cyprus in 2013. Cyprus had a similar banking model on a smaller scale. It attracted foreign deposits, primarily from Russia and Eastern Europe, by offering banking services and favorable tax treatment. The business model looked similar to Switzerland's. Then the Cypriot government, facing a debt crisis, seized depositor funds above a certain threshold to pay government obligations. Trust was destroyed overnight. Capital fled immediately and never returned. The Cypriot banking sector collapsed by roughly 80%. The country had the infrastructure, but violated the fundamental principle. Once trust breaks, it cannot be rebuilt quickly. Switzerland has never done this, not during World War I, not during World War II, not during any financial crisis. The commitment to client asset protection has been absolute for over 2 centuries. This consistency is what allows the monetization to work. Trust monetization only functions if the trust is earned and maintained over long time periods. Switzerland has done that. The mechanism works because the foundation is real. Capital magnetism is about policy design. Switzerland has structured its economic and regulatory environment to make capital want to stay, not through controls or restrictions, but through incentives and predictability. The Swiss franc functions as a safe haven currency. During every major financial crisis, capital flows into Switzerland seeking stability. In 2008, during the financial crisis, massive inflows occurred. In 2011, during the European sovereign debt crisis, the franc appreciated so much the Swiss National Bank had to intervene. In 2020, during COVID uncertainty, the same pattern repeated. Capital seeks safety, and Switzerland is perceived as safe. This perception is backed by policy. Switzerland's tax structure uses cantonal competition to create legal tax optimization. Different cantons offer different corporate tax rates, typically ranging from 11 to 21%, depending on location and business type. Companies can choose their canton based on tax efficiency. This is legal, transparent, and predictable. Businesses know their tax obligations years in advance. Regulatory certainty matters more to capital than low taxes alone. Switzerland does not impose retroactive taxation. It does not nationalize private assets. It does not suddenly change rules. Property rights are absolute and contracts are enforced consistently. For capital allocators, this predictability reduces risk, which makes Switzerland attractive even if nominal tax rates aren't the absolute lowest available. The result is that capital flows in during crises and tends to stay because the structural advantages persist. This is capital magnetism in action. Compare this to France between 2012 and 2017. When François Hollande was elected president, he proposed a 75% wealth tax on high earners. The policy was intended to raise revenue and address inequality. The actual result was immediate capital flight. Wealthy French citizens relocated to Belgium, Switzerland, and the UK. Actor Gérard Depardieu famously renounced his French citizenship and moved to Russia. The wealth tax was eventually reversed in 2017, but the damage to France's reputation as a stable jurisdiction for capital was done. The irony is that tax revenues fell despite higher rates because the tax base shrank. People and capital left. Switzerland, meanwhile, maintained lower rates and higher predictability. The result was higher revenue, not lower, because the tax base expanded as capital moved in. Capital magnetism requires understanding that capital is mobile and responds to incentives. Switzerland designs policy accordingly. France, during that period, did not. The difference in outcomes was predictable. Service capture is Switzerland's least understood but perhaps most important mechanism. The country earns enormous revenue by controlling and intermediating economic activity that physically happens elsewhere. The clearest example is commodity trading. Approximately 35% of global oil is traded through Swiss-based firms. Around 60% of metals and minerals flow through Swiss commodity traders. Companies like Glencore, Vitol, Trafigura, and Gunvor are headquartered in Switzerland. The physical commodities never touch Swiss soil. Oil is extracted in the Middle East, refined in Asia, and consumed in Europe. But the contracts, financing, insurance, and legal structures are managed from Geneva or Zug. Switzerland captures trading fees, financing fees, insurance premiums, legal fees, and contract enforcement revenues from this activity. The margins are high because the service is specialized and the capital requirements are low compared to actual production. This is intermediation at scale. Asset management works the same way. Switzerland manages $3.45 trillion in assets, but most of that capital is foreign. Swiss firms earn management fees on Brazilian pension funds, Middle Eastern sovereign wealth, Asian family offices, and European corporate treasuries. The capital isn't Swiss. The fees are. Multinational corporations use a similar model. Nestlé, Novartis, Roche, and ABB are headquartered in Switzerland but operate globally. Nestlé sells infant formula in Africa. Novartis sells pharmaceuticals in America. ABB sells industrial equipment in Asia. The production and sales happen worldwide. Switzerland captures the corporate taxes, high-value employment, and service fees from headquarter operations. This is service capture. The value creation happens elsewhere, but Switzerland controls enough of the value chain to extract substantial revenue without needing to produce physical goods at scale. The historical counterexample is the Netherlands in the 1700s and 1800s. Amsterdam operated a similar model. The Dutch East India Company was the world's most valuable enterprise, built entirely on intermediation. They didn't produce spices in Indonesia. They controlled the trade routes, financing, and distribution. The model worked brilliantly for over a century. But the Dutch failed to adapt when trade routes shifted and British scale overtook them. They had the mechanism, but couldn't maintain it when external conditions changed. Switzerland learned from this. Service capture only works if you can defend it and adapt it over time, which brings us to the fourth mechanism. Adaptive resilience is Switzerland's ability to change policies and business models in response to external pressure without destroying the underlying economic structure. This is harder than it sounds. The clearest example is the banking secrecy pivot. From 1934 until the 2000s, Swiss banking secrecy was absolute. The model attracted enormous capital from around the world. Then external pressure mounted. The 2008 financial crisis made tax evasion a political priority. The United States went after UBS aggressively in 2009. The OECD pushed for transparency. Other secrecy jurisdictions, like Austria and Luxembourg, faced the same pressure. Switzerland adapted. In 2017, Switzerland implemented an automatic exchange of information, sharing tax data with other countries. This was a fundamental change to the business model. Banking secrecy, as it had existed for decades, was effectively over. Other jurisdictions collapsed when forced to make this change. Austria's banking secrecy industry shrank dramatically, but Switzerland managed the transition. They moved from "we hide your money" to "we manage your money in full compliance with international standards." The value proposition shifted from secrecy to competence, stability, and service quality. The result? Assets under management didn't collapse, they grew. Between 2017 and 2025, Swiss AUM increased by approximately 25%. The country lost some footloose capital that was there purely for secrecy, but it gained institutional legitimacy and attracted compliant wealth. The adaptation worked. Another example is the Credit Suisse crisis in March 2023. Credit Suisse was a global systemically important bank. Its failure would have caused enormous damage to Switzerland's economy and reputation. When the crisis became acute, Swiss authorities orchestrated an emergency takeover by UBS over a single weekend. The deal was structured, approved, and executed in days. No depositors lost money. No systemic contagion occurred. The crisis was contained before it became catastrophic. This is adaptive resilience in practice, recognizing when the existing model is under threat and changing it quickly enough to preserve the system. Compare this to Britain's experience from 1931 to 1976. The British pound was the world's reserve currency for over a century. When that status came under pressure after World War I, Britain tried to maintain the old model. They stayed on the gold standard until forced off in 1931. They tried to preserve the pound's international role even as the economic fundamentals deteriorated. In 1944, at Bretton Woods, the dollar replaced the pound as the primary reserve currency. Britain continued trying to defend the pound's value through the 1950s and 1960s. In 1967, a devaluation crisis forced a 14% overnight drop. In 1976, Britain had to request an IMF bailout. Britain kept trying to preserve the form of the old system instead of adapting the function. Switzerland does the opposite. It preserves the function, economic stability, and capital attraction, but changes the form as needed. Banking secrecy ends, but wealth management continues. One major bank fails, but the system survives. Monetary policy shifts, but the objectives remain consistent. Adaptive resilience is what allows the other three mechanisms to continue working even when external conditions change. It's the mechanism that makes the model durable over long time periods. Understanding what Switzerland does is useful. Understanding what others do differently is equally important. Several countries have attempted similar models with partial success. Singapore gets 3 of the 4 mechanisms largely right. It has capital magnetism through favorable tax policy and regulatory stability. It has service capture through its position as a regional financial and trading hub. It has adaptive resilience, demonstrated by its ability to pivot economic strategies over decades. What Singapore lacks is the depth of trust monetization. It's a newer financial center, established primarily after independence in 1965. It doesn't have centuries of institutional continuity. Political risk is also higher because Singapore is effectively a one-party state in a geopolitically contested region. If China were to move on Taiwan, Singapore's position becomes precarious in ways Switzerland's does not. The model works brilliantly for Singapore, but it has vulnerabilities that Switzerland doesn't face due to geographic neutrality and longer institutional history. Luxembourg gets 2 mechanisms right. It has tax optimization for corporations and service capture through fund administration. It's the largest fund domicile in Europe after the US. But Luxembourg's model depends on operating within the European Union as a regulatory arbitrage play. If the EU harmonizes taxation or financial regulation more completely, Luxembourg's advantages diminish. It also lacks true independence. EU policy changes can force Luxembourg to adapt in ways Switzerland, which is outside the EU, can avoid. Britain has the institutional infrastructure and historical trust from centuries as a global financial center. London remains one of the world's major financial hubs, but Britain has lost ground on capital magnetism and adaptive resilience. Fiscal policy has been unstable. Tax rates change frequently. Regulatory policy shifts with political winds. Brexit created enormous uncertainty. The result is capital outflows. In 2025, the UK is projected to lose 9,500 millionaires, a significant net outflow. London is still important, but the trajectory is concerning. Switzerland, by contrast, is gaining the capital that Britain is losing. The four mechanisms working together create a compounding advantage that partial implementations can't replicate. Switzerland's economic model works because all four mechanisms operate simultaneously and reinforce each other. Trust monetization generates revenue from stability. Capital magnetism brings in assets to monetize. Service capture earns fees from economic activity happening elsewhere. Adaptive resilience allows the model to survive changing conditions. Remove any one mechanism, and the model weakens significantly. Austria had banking secrecy, but lacked adaptive resilience when international pressure mounted. Cyprus had foreign deposits, but violated trust. Luxembourg has service capture, but lacks full independence. Britain has institutional depth, but lost policy stability. Switzerland maintains all four, which is why the model continues working even as other financial centers struggle. The economy isn't dependent on any single industry or advantage. It's built on a combination of policy choices, institutional design, and long-term consistency. The numbers reflect this. Swiss private banking revenues are up, assets under management are growing, international firms are expanding Swiss operations, not contracting them. Goldman Sachs, JP Morgan, and Morgan Stanley have all increased their Swiss presence in recent years. If the model were broken, capital would be leaving. It's not, it's arriving. This doesn't mean Switzerland is invulnerable or that the model will work forever unchanged. External pressure will continue. International tax cooperation will increase, geopolitical dynamics will shift. But Switzerland has demonstrated an ability to adapt while preserving core functions. That adaptive capacity, combined with the other three mechanisms, is what makes the model durable. Understanding how Switzerland works provides insight into how economic systems can be designed for resilience rather than just growth. The lesson isn't that every country should copy Switzerland. Most can't, and most shouldn't try. The lesson is that economic models built on clear mechanisms, consistent policy, and institutional trust can survive disruptions that break less coherent systems. Switzerland's economy works because the structure is sound and the mechanisms reinforce each other. That's not magic, that's design, and it's why the model has lasted over 200 years. Thanks for watching the Money Timeline.